Hey boys, I hope you're all doing really well. Welcome to you all to the next video on the CA final cheat sheet preparations. Today we are doing something really exciting. We are going to be discussing about all the PGBP adjustments which are there and relevant for your examinations. I have taken some opportunity and I have created a cheat sheet for all of you, where in this cheat sheet, in a simple manner, in just about, let's say, 7 pages, in just about 7 pages, you will have covered all the adjustments of your PGBP computation and you will be able to get the right answer for the PGBP taxation. Yes. Now, before I go forward, let me clarify this once again. I've done this in the earlier video as well. Cheat sheets are not a replacement of your main guidance, people. Cheat sheets only give you a summary of how the document should look like. This helps you with the format preparation. This helps you with understanding of the topics a little bit faster the day of your exams. It does not become the substitute for your main reading. So please go through the main book first, understand the topic, understand the provisions very carefully before you start looking into this, because then only you will be able to appreciate this cheat sheets a little better. Clear? Great. As we are going into the cheat sheet, people, let me first clarify some basics for you. I'm pretty sure you should be aware about these basics now that you're in CA final, but nevertheless, I think this is something very important. Most of the people who end up making mistakes in PGBP is probably because of this. So let's spend 2 minutes of time on this understanding and then we'll take it forward. Yes, when it comes to PGBP, the first and the most critical thing which you need to understand, people, when it comes to PGBP computation is how are you looking at it in accounts. Yes, let's understand this carefully, that when you do PGBP computation, the first and the most critical thing is for you to know what exactly is the treatment which has taken place in accounts, basis which you make the treatment in taxation. The major issues which happens in exam is that a student ends up knowing the provision. He knows something should be allowed, he knows something should be added, he knows something should be disallowed, he knows something should be taxed. But unfortunately, he forgets to read the question. Most often, it so happens that when you read the question, you may realize that the question may have already done the same treatment which you are looking forward to. In which case, you making an additional adjustment is only overinflating the income or underinflating the income. Yes, so you need to be careful as to first what is happening in accounting perspective. Keeping that in mind, let's understand this carefully. First of all, always when you start a PGBP question, the first and the critical starting point becomes a net profit before taxes. Yes, so you start from net profit before taxes, and there are 4 critical things which you need to do in order to arrive at your tax P&L. What exactly does the tax P&L have to do? Tax P&L will do 4 of these items. First is called as disallowance, second is called as additions, third is called as allowance, and fourth is called as reductions. What does this mean? If you read the words very carefully, the first word says disallowance. Disallowance in itself means that you are looking at something which is there and should not be there. Which is there and should not be there. Now I'm using these 2 words carefully, people. There and not be there. Every time I use the word there first, it means I'm talking about accounts. Not there means I'm talking about income tax. So which means I'm going to start with accounts and then I'm going to arrive at income tax carefully. Yes, so if I'm coming and telling you that I'm doing something called as a disallowance, it means something was allowed in accounts and should not be allowed in taxation. When you say allowed in accounts, you're talking about expenses. Yes, so disallowance in all practical sense means you have an expense in accounts. You have an expense in accounts which is debited to P&L already. But income tax says please do not claim it as a deduction. Please do not claim as a deduction. For a simple example, you have a section called 40A3. 40A3 says that if you have made any payments in cash more than 10,000 rupees, you cannot claim it as a deduction. Yes or no? Yes, but if you understand this carefully, people, I can only make the disallowance if it is already there in the P&L, which means if it is not there in the P&L, am I going to make the disallowance? No. So let's keep that thought in mind. Next comes something called as additions. Additions in its word itself means that, people, I'm adding something. Now, where am I going to add? I'm going to add it in income tax, which means it is not there in the P&L. Yes, so addition means something which is not there in P&L and I'm adding it in my income tax. Now, people, when you're adding something, obviously income is going to increase, which means you're talking about something being an income here. Yes or no? Yes. So understand this carefully, people. When you use the word disallowance, disallowance only talks about expenses. Addition talks about incomes. Great. Then you move on forward, people, to something called as allowance and reduction. Third item is called allowance. Allowance means something which I'm doing in taxation. I'm going to allow something in taxation. When you're going to allow something in taxation, you're only going to do it because it is not already there. It is not already there, and therefore allowance means something which is not in P&L but is allowable in income tax perspective. I am talking about expenses. And that brings me to the last one, which is called as reduction. Reduction means income, an income which is already there in P&L, but I'm saying I don't want to tax it under PGBP, probably because it pertains to other heads of income. It pertains to other heads of income. Yes. So there are 4 words which you critically need to know and understand before you start doing a PGBP computation. Word number 1 is what, my friends? Word number 1 is something called as disallowance. Disallowance means something which is already as an expense in P&L, but income tax says do not claim. Second word is called additions. Item which is an income but not there in P&L, I am proposing to make it an income in income tax. Third thing is called as allowance. Allowance being an expense which is not in P&L, but you're choosing to treat it as a claimable item in income tax. And fourth thing is called as reduction, where an income is already there in P&L, but I'm saying I don't want it to be part of my P&L. I want it to be part of some other head of income. Some other head of income. Yes, these are the 4 critical adjustments which you need to make in PGBP. But if you remember this carefully, I was just telling you that there can be an instance where you have something in P&L already and you don't want to do anything about it. That is where the 5th adjustment comes into picture, the critical adjustment, which is called as ignorance. Ignorance in simple words means, people, that something is already there in P&L. And accounts is also saying, sorry, tax is also saying, yes, let it be there in P&L. What is your problem here? Yes, in which case, people, there is nothing to do, because if you understand, my P&L already has made that adjustment and tax also says keep the adjustment. In which case, will I make any changes? No, I will not make any changes. So therefore, that will become an ignorance item. Yes, a simple example, people, if the question comes and says there is salary debited to P&L. Now salary is already debited to P&L. In income tax, do you have a problem with that? No. When you don't have a problem with that under income tax, you will say income tax also will say allowed, in P&L is also saying allowed, and therefore both are matching to each other. Do I have to make any changes? No, I don't have to make any changes. Are we clear? Yes. So these are 5 critical adjustments based on which your whole PGBP computation gets into analysis. If you understand these 5 computations, you will be doing a lot better job when it comes to your calculations, when it comes to your 15-mark questions. Clear? Great. Now, for the purpose of cheat sheet, people, what we have done is we have simply combined the first 2 items together. We have combined the second 2 items together, and we have kept the third item separately. So that you understand this carefully. Are we clear? Yes. One thing which I wanted to particularly understand, people, is that when I say item to be added in my sheet, I am only saying this item to be added because either it is not there in P&L and it's an income which I need to add, or if it's an item which is there in the P&L as an expense but I don't want it to be there. So that part of the understanding you should already have when you're reading the cheat sheet, people. Don't blindly follow the fact that Rahul has given something on the left side, so I directly need to add. No, I have also mentioned it at appropriate places, saying it is debited to P&L or credited to P&L. So keep that understanding in mind. Are we clear? Yes, great. Let me show you how the PGBP cheat sheet looks like, people, so that you understand this a little better. Like I said, there are 3 columns which are starting with you. First thing is called as items to be added, second is called items to be reduced, and third is called items to be ignored. Now, when I'm saying items to be added, like I told you just now, items to be added would be either an expense which is getting disallowed, or it is going to be an income which is going to be added. When it comes to reduced, people, what is it going to be? It is going to be an expense which is going to be allowable, or it is going to be an income which is going to be reduced. Items to be ignored would be items which are part of P&L and should be there in P&L. Yes or no? Yes. So please keep that understanding in mind, people. Other than that, the cheat sheet has been prepared beautifully. I've categorized them into section levels also. Yes. So section level category has been given. All adjustments which are there in ICA study material plus your past exam questions, all have been taken into consideration for the purpose of preparing the cheat sheet. So fairly a good comprehensive cheat sheet has been prepared for you. I don't think you'll need anything more than this for your examination preparations. At some appropriate stages, people, you'll notice some items are highlighted in yellow. What is this items highlighted in yellow? Very simple. All those items which are not part of the special tax regime. Yes. So which means if it's a part of a normal tax regime and special tax regime, you'll see it in normal colors. But if you see item in yellow, it means these items are not claimable under special tax regime. You will ignore them for the purpose of special tax regime computations. Clear? Yes, great. Let's start doing it one by one, people. I think you'll understand this a little better when we start doing it together. First item, if you notice, is section number 28, which is talking about your charging section. Yes, so charging section computation is what we are discussing right now. In charging section computation, income tax says, first of all, always start with your net profit before taxes. So if you have your net profit before taxes, I'll put it on the last column and I'll start from them. In that, the first adjustment which I'm going to make is any kind of sale proceeds of import entitlement of your duty drawbacks and your indirect taxes scheme. Yes, one question which came in ICI in the past is that there was a sales proceed which came from import entitlements which the person had passed in his general reserve. Now, if you remember section 28, charging section comes and says any kind of indirect tax related duty drawbacks, any kind of benefits coming out of it will be taxable under the head PGBP, and therefore if it is not already credited to P&L account, I will now credit it to my P&L account. Yes, second, any kinds of benefits, perquisites or gift which is received in a business, if it is not credited to P&L account. A classic case, people, when the question comes and says any gift has been received during your business operations, either you received a free TV, a free air ticket or whatever it is, all those kind of items you should be taxing in the head PGBP because it is a gift received under PGBP. No limits given to you on this, fully taxable under the head PGBP. So if it is there in P&L, great enough, don't do anything further for it. But if it is not there in P&L and it is not credited to P&L account, please treat it as an income. On the right side, people, what are items to be reduced? Income tax comes and says if you have any kind of interest income which is coming from share application money which is deposited in a bank account which is due to a statutory requirement. This was a case law which was introduced by ICI where it came and said if in the case of a Sri Rama Multitech, it was coming and clarifying that when you have incurred some interest, when you have incurred some share issue expenses, for getting money for share application, and this money if you're keeping in a bank account, whatever interest you're getting from this bank account will not be taxable under the head PGBP or IFOS. It would rather be reduced from the share issue expenses because this interest income is directly linked to the expenses which are incurred. Yes, and therefore in this case, what will I do? If I have treated it as a P&L item in my books, I will remove it from the P&L item and I will reduce it from the share issue expenses, which means it's an income which is showing in my P&L, should not be there in the P&L, and therefore I am allowing it or reducing it. Yes or no? On the right side, people, is something called items to be ignored, where your case law of K and Co comes and clarifies that if you have an interest on bank FD, which is coming and kept as margin money for the purpose of obtaining bank guarantee as a part of a contract. Now in K and Co, they had come and clarified that normally when you talk about interest income is always IFOS income. But if it is so found out that the interest is earned from a bank account or a special FD which is created solely for the purpose of honoring a contract, in that case the interest income is not incidental anymore. It is a mandate for the purpose of the contract, and therefore that interest income will become part of my business operations and will not be an IFOS income. So this is what K and Co is coming and clarifying. Now, if you understand this carefully, interest income will be part of my P&L already. Normally, I would treat it as IFOS income, which means I'll reduce from PGBP and take it to IFOS. But because here I'm clarifying that this is taxable under the head PGBP, I will leave it as it is because it is already there in P&L. No adjustment to be made. Yes? Sweet. Move on forward, people. Next items are, first item saying expenses relating to income which are taxable under other heads of income. If you are going to have an income which is taxable under other heads of income, the corresponding expenses also should be treated as other heads of income. Yes, and therefore if that other expenses are a part of my P&L, I will simply add it back. Yes, so that is what this is coming and clarifying. And then comes loss from sources which are exempt. People, if the share of profit from a partnership firm is exempt, the share of losses is also exempt. So if the P&L has anything called a share of losses or any other item which is exempt from taxes, I cannot claim it as a deduction. If it is already there in my P&L, it is reducing my net profit. Can I allow that? No. And therefore that will get disallowed. This is part of my section number 14A. Are we clear? Yes, great. Next item, people, says incomes taxable under other heads of income. This is fairly obvious, like we discussed the expenses. If the income is taxable under other heads of income and it is part of my P&L, then I will remove it from my P&L and take it to the other heads of income. How do I remove? I will simply reduce it. And then comes share of profit from HUF, people, because share of profit from HUF is exempted from taxes. Are we clear? Yes, great. Next one says fair market value on conversion of stock in trade into capital asset. I think this is fairly something which you are all aware about. When a stock in trade is converted into capital asset, the fair market value on the date of conversion becomes my PGBP income. This is part of my section 28 as well, and therefore income tax says if it is already there in P&L, then there is no problem. But if you have not put it in your P&L, please add it to your P&L, and therefore I am putting it in addition. Yes, notice carefully, it says if not credited to P&L account. Yes, so if it is not credited to P&L account, I will now credit it to my P&L account. Are we clear on this? Yes, sweet. These are your first charging section related adjustments, people. I hope we are clear till here. Great. Let's move on forward. The next adjustments will be relating to accounting errors. Now, these are instances where what has happened is accounts itself has made a mistake while preparing the P&L, and therefore during income tax, I am not looking at income tax related provisions. I am just trying to rectify my accounts. Item number 1, if you notice, is undervaluation of closing stock in the books of accounts. Now, people, when an undervaluation of closing stock has happened, it means my closing stock is showing lesser. If the closing stock is showing lesser, my net profit is showing lesser in my accounts, and therefore to rectify it in my income tax, I will simply add it back. So whatever undervaluation I have, I'll add it back. On the similar logics, people, if you have any overvaluation of opening stock is already an expense. If you're overvaluing it, the expense has increased and therefore the net profit has decreased. Can I do that as an allowance? No. And therefore income tax says whatever overvaluation happens, you can simply disallow. Clear? Great. On the similar logics, people, if you come to the right side, it says overvaluation of closing stock. Now, if closing stock is overvalued, the net profit is already higher. Do I want to show that much high? No. And therefore, I will reduce it from my P&L. And if it is undervaluation of closing stock, the same logic remains. However, look at the critical ones. The critical one comes and says purchases which are omitted to be recorded in books of accounts. If you get a question in exam which comes and says there are some purchases which have not been recorded in books of accounts, an assessing officer is not allowing it despite it being genuine, the case law of Kedarnath Jute Manufacturing Company came and clarified that if the purchases are genuine and if you have bills, if you have some documentary evidence like purchase inward document, your e-way bill and everything which can justify this as an purchases made by you, you can claim it as a deduction, and actual invoice will not be the sole deciding authorities. Yes? Great. Coming to your ignorance items, there is something called machinery spares which are forming part of closing stock. Now, most of the people here will end up going wrong. If you think about this carefully, this is a machine spare. As per ICDS 5, they will come and say a fixed tangible asset, all machinery spares should be added to the asset cost. So most of the people, what they'll do in this part is that they'll come and say, since machinery spares is there in my closing stock is showing higher. Because my closing stock is showing higher, they'll reduce it from the closing stock and capitalize it in the asset cost. Now, what you have done till now is right. There is no problem here. The only mistake which you did not realize is you did not realize how accounting worked. If a machine spare is showing in closing stock, people, it can only happen because of the reason that it was first purchased. Yes, which means this machinery spare which is showing part of your closing stock would have also been purchased and would have been part of my purchases. At the same time, if it is not purchased, it would have been purchased in the past years, which means it will be part of my opening stock. So no matter how you look at it, if an item is already there in closing stock, it is automatically going to be part of my opening stock or my purchases as well. So if you are going to rectify your closing stock, you should also be rectifying your purchases and opening stock, which in simple words means that the purchase item and the closing stock item has knocked each other off. And if they've already knocked each other off, there is no treatment required in P&L. Yes or no? Yes or no? Yes, this is one very beautiful question which I had asked in the past. So please pay attention to this. If the question comes and says the machinery spares of ₹100 is showing in closing stock, you ideally will come and say this should be reduced because it is forming part of my closing stock. But what you're missing out to the fact is that because this machinery spares is showing part of the closing stock, it would also be part of my purchases. Yes, because it is also going to be part of my purchases, I need to add it back there also. In simple words, the net effect has become 0. And therefore, if you notice, people, I've put it in items to be ignored because it is already there in the P&L on both the sides. There is no requirement for me to make any adjustments there. Are we clear? Yes, important adjustment, pay attention. Then from here, I think things will start becoming simpler. We're first looking at section 30 and 31. Section 30 and 31 talks about expenditure incurred for the purpose of plant and machinery and building. Income tax comes and clarifies if you have any kind of capital repairs which are incurred for the purpose of these assets, then obviously you cannot claim it as a deduction. You will have to capitalize it to the asset cost, and therefore whatever capital repairs you have incurred, if it is forming part of P&L, please disallow. Next, if any percentage of expenses incurred on a building and plant and machinery is used for personal purposes. If a question comes to you in exam and comes and says there is a certain expense showing in P&L, 40% of which is forming part of my personal nature. In that case, the 40% of the expense cannot be claimed as a deduction. Since it is already there in the P&L, I am disallowing it off. Yes or no? Yes. On the similar lines, people, please notice one thing which most of the people end up making mistakes is that if you have disallowed something as a capital repair on the left side, you have already added it to my asset cost. Now, because you've added it to the asset cost, you should be claiming depreciation on it. Yes or no? Yes. And therefore, the next item is if you have already claimed some disallowed item on the left side, on the left side, the one which we are speaking about right now. Yes, then in that case, the depreciation on this asset will be allowed as a deduction. This is not something ICI will tell you. You should be aware about it. Yes, items which should be ignored because it is already there in my P&L. Any kind of rent expenses, revenue repairs, and all those things which are incurred can be ignored off because it is there in the P&L. It should be there in the P&L. Yes, so these items will not take any adjustments. Clear? Great. I'm assuming we are going at a great pace, people. Let's continue the same pace. We are looking at section number 32. Section number 32 talking about a depreciation section. This section basically comes and says if you have any items which are there as a part of accounts depreciation, please disallow that because you can only claim depreciation as per income tax. Yes, the first item in this is any kind of capital assets which is charged to P&L. This is something which you have to pay attention to, people. This is not something which ICI will tell you. It will be showing in the P&L account. So if you look at the P&L account, look on the debit side, and if you see items like purchase of computer, purchase of television, purchase of furniture and all, please note that these are all capital assets, could not have been claimed in the net profit. This is technically an accounting error. So please disallow that expenses in the P&L and start claiming depreciation on those. Next, also disallow any kind of depreciation which is showing in books of accounts, people, because you're going to be computing depreciation as per section 32. You cannot be claiming depreciation as per your account. So therefore, whatever accounting depreciation is showing will get disallowed and you'll claim depreciation as per section 32. On the right side, people, items which you can claim as a deduction is first one, any item of depreciation which is as per section 32 can be claimed as deduction. That is fairly obvious. Items which can also be claimed as deduction which may not be mentioned in the question is any kind of additional depreciation for newly bought plant and machinery if it is for a manufacturing or a power sector entity. If it is for a manufacturing or power sector entity, notice carefully that you can only claim additional depreciation for manufacturing and power sector entity. But yes, I've also put it in yellows. Yellow in simple words means that these additional depreciation can only be claimed by those people who are opting for normal regimes. If you're going for 115 BAA to BAE, you cannot claim additional depreciations. So this adjustment will get ignored off. Third item is a case law question, people, where they come and clarify any kind of depreciation on assets which are installed at the residence of the director is also claimable as deduction. Please notice that this is only claimable as deduction because of the fact that it is showing it's a director's office. Notice that you generally will not claim any kind of depreciation on personal assets, but in a company, a director is not a personal person. Yes, a director is also an employee of the company, and therefore any assets which are installed in the director's premises, ICI has taken a view that this is not personal in nature and will be called as a business expense, and therefore whatever depreciation is coming on that asset can also be claimed as a deduction. So please ensure that you claim deduction on this as well. Yes, next item, people, on the right side is any kind of depreciation on capital assets if it's purchased from one person otherwise and by prescribed modes exceeding rupees 10,000. Yes, so this is a clarification in section 43 which comes and says that if you have bought an asset by paying cash more than 10,000 rupees to a single person in a single day, then please note that this is an asset. So there is nothing to disallow in my P&L. However, you will not be eligible to claim any depreciation on this asset going forward. So to the extent of that asset cost, I will ignore it from my computational model and then I'll compute depreciation only on the balance numbers. For instance, if the question comes and says that the asset which is purchased is 1 crore in which 40 lakh rupees was paid by cash and 60 lakh rupees were paid by permissible modes, I will take the 40 lakh rupees and I will ignore it for the purpose of computing depreciation. In simple words, I'll do depreciation only on the 60 lakh rupees. Are we clear? Yes? Great. What other things do we have, people? Items to be added when it comes to depreciation, some more, is depreciation which is claimed on non-compete fees paid to retired partners. This was a case law of Asianet Communications, where Asianet Communications basically came and clarified that if you have taken any non-compete, if you have paid any non-compete fees to your partners who have retired, the problem here is that this is not creating any new asset. And therefore there is no depreciation which is allowable on this non-compete fee, and therefore if any depreciation has been claimed on this, I will disallow it for the purpose of computation. Notice at CA final level, you can only claim depreciation on assets if they have enduring benefit. Just because you make a capital expenditure, it does not mean it will give an enduring benefit. Not every capital expenditure is allowable for depreciation. This is one of the classic examples where if you're making any kind of non-compete fees payments to your directors, then whatever asset is being, whatever capital expenditure is being incurred will not be eligible for any depreciation because there is no enduring benefit coming from the non-compete fees. Then comes items to be reduced. Any kind of depreciation on assets which is registered in the name of directors or partners. Yes, this was a case law of ICDS Limited and Mysore Minerals, where this case law basically come and clarified that just because you've bought the asset in the name of your director or your partner does not absolve the fact that this asset is used for the purpose of business. It can still be used for the purpose of business. It is only for the purpose of legal orientations that you're registering in the name of directors and partners, and therefore it is still eligible for deduction as a depreciation. The business can still claim depreciation on these assets even if it is registered in the name of directors or partners. Adjustment is permitted. Then comes your items to be added. One-time license fee is to be added for the purpose of franchise, because this is also a capital expense. Yes, so if you have any one-time license fee which you have purchased, then that is also to be added, and you can claim depreciation at the rate of 25% on this. Yes, so 25% worth of depreciation is allowable on this asset cost. Items which can be reduced is any profits from hedging contract which is entered for importing machineries. Any kind of profit which is incurred for hedging contracts, which is incurred for the purpose of any kind of machineries, can be claimed as deduction. What is this, people? This is coming and clarifying that if you have any profit from hedging contracts which you have earned for the purpose of machineries, section 43A will come into picture. Section 43A will come and clarify that if you have incurred any kind of asset, foreign exchange difference, for the purpose of any imported machinery, then that should form part of the asset cost and cannot be taken to P&L. Because this is a profit, you cannot claim it in your, you do not need to offer it as income tax. You can rather reduce it from the cost of the asset, and therefore I will reduce it from my P&L. I will also reduce it from my asset cost. I will also reduce it from my asset cost. Are we clear? Yes, yes, great. This is what your section 32 looks like. Now, by this time itself, you would have realized, people, this sheet is not coming and talking about the rates of depreciation and everything. So that's something which you need to know from your material itself. If not 99%, I say I would give you the rates in the question itself, so you need not worry about it. Are we clear? Awesome. Great. Then we're moving on to section 35, people. Section 35 talking about scientific research. Now, scientific research income tax basically comes and says what? Any kind of scientific research expenses you incur, whether in-house or for the purpose of donations, can be fully claimed as deduction except for the purchase of land. Yes, so if the question comes and says any kind of capital expenses which you incur other than the land which is relating to scientific research, if it is already not debited to P&L account, you can claim it as a deduction. You can claim it as a deduction. Notice carefully that this is only claimable as deduction if it is not debited to P&L account. If you get a question in exam which says it is already debited to P&L account, please ignore the adjustment of, because it is already there in P&L. Tax also permits you to have it. Items which need not be taken into consideration, any kind of revenue expenses and donations which are relating to scientific research and statistical research, because it is allowed as deduction, already part of P&L, therefore no further treatment to be made. Items which to be ignored is purchase of land for the use of scientific research, because people, land would have not been debited to P&L account. Yes, a land would have not been debited to P&L account. Do you want to claim it as a reduction right now? No, don't claim it as a reduction. It is already not part of P&L. I do not want it to be part of P&L as well, and therefore that will get ignored off. However, please notice that any kind of donations which are relating to scientific research have been highlighted in yellow, because income tax comes and clarifies if you're opting for any special tax regime, the donations which have been paid to any other scientific research or statistical research areas cannot be claimed as a reduction. It has to be disallowed. So if this is part of my P&L, I will add it back. I will add it back for the purpose of my new tax regimes. Yes, what are the items which is to be added to P&L, people? Is item like this, where the question says profit from sale of capital asset which is used for scientific research. So if you get a question that the scientific research asset has been used in the business, has been used for research purposes and then sold off in the market directly, please do not take it to capital gains. Income tax specifically comes and tells us under section 41 that this will be treated as an income for the purpose of PGBP only. So if it is a profit which is there for these assets, you will take it to your P&L. If it is not there in the P&L, please add it to your P&L. If it is there in the P&L, please let it go. Are we clear? Yes. Great. Then we move on to section 35 AD, people, which is called as specified businesses. In specified businesses, again the same rule applies. If you have undertaken any specified businesses, whatever assets you have purchased for that business, can be treated as an allowable deduction except for land, goodwill and financial instruments. And therefore, again the same thing, people. If you have any capital expenses other than land which is relating to specified businesses and it is not debited to P&L already, you can claim it as a deduction. If it is any kind of purchase of land, please don't claim it as a deduction, because it is not allowed as a deduction. If it is not in the P&L, please don't take it into consideration itself. You can ignore the adjustment of. Second, ignore all those capital assets which have been bought for specified businesses if they are purchased by prescribed modes in a day exceeding 10,000 rupees. So if you're going to purchase it for a price exceeding 10,000 rupees, you cannot claim it as a reduction, people. So therefore, if it is not there in the P&L, please ignore it off. Please ignore it off. At the same times, if you're going to have a scientific research asset which you have used for the purpose of, if you're going to have an asset which is used for specified businesses and then you have sold the asset, then whatever profits you're getting out of it will be taxable under the head PGBP. If it is not there forming part of P&L, please take it into your P&L. Please take it into your P&L. If that is not the case and you have taken this asset and sold it to your other businesses within a period of 8 years, then in that case what you'll do is you will compute proportionate depreciation for the period you have used it for the specified businesses. Anything extra which you have claimed as a deduction earlier will now be added back. Which is what it says, people. The computed WDV of the capital asset which is used for scientific research, if the asset is sold within 8 years. If that asset is sold within 8 years, all these will be taken into consideration. Now notice carefully, people, the whole section 35 AD is not forming part of special tax regimes. So therefore, this whole model will not work out. In that case, you will move back to section 32. You will move back to section 32, which means asset will be remaining as an asset under section 32. All treatments of section 32 will apply. Clear? Great. Then we have section 35 CCC and section 35 CCD. Nothing to be added, nothing to be reduced. Items to be ignored is what we are discussing. If you have incurred any kind of notified agricultural extension project, if it is already debited to P&L, income tax says you can claim 100% as deduction. There is no problem. Therefore, you can ignore it off. At the same time, if you have incurred expenditure for notified self-development projects, and this also is 100% allowed as deduction. So if it is already forming part of P&L, please claim it as deduction. Now, I've already clarified this, but I'm explaining it once again. If it does not say that it is part of P&L, which means if you read the question and the question says it was missed out to be recorded in my P&L, then you can claim it as a deduction, people. Yes, notice it's an expense. If it is there in the P&L, then I will ignore. If it is not there in the P&L, I will move it to the middle one, which is items to be reduced off. I hope you understand that much till now. Clear? Now, again, special tax regimes, therefore not allowable as deduction. So if you are in special tax regime, you will ignore all these adjustments. You cannot claim it as deduction. If it is already there in the P&L, please disallow it off. Please disallow it off. Moving on forward to section 35 ABA and 35 ABB. This one comes and says that if you have any kind of spectrum fees or any kind of license fee which you have incurred, then whatever spectrum fees and license fee which you have incurred can be claimed as a deduction over the unexpired life of the license. The one rule which is there here is that, people, you can only claim it after it is actually paid. So please pay it off. From the rate on which you make the payment, you can claim the deduction over the unexpired period of the license. However, if the license is bought before even the business has commenced, then in that case you will take it from the rate of the commencement of business for the next unexpired period of license. You can claim it as a deduction. Now if it is not there in the P&L, then you can claim it as deduction. If it is there in the P&L, please note that you can only claim the amortized portion, which means anything excess will get disallowed. Are we clear? Great. Moving on forward, people, to something called deferred expenses. This is part of section 36 and 35 together. Deferred expenses, first item is called family planning expenses, which is incurred by non-companies. People, notice family planning expenses as such is only claimable by companies. If it is claimed by non-companies, I will fully disallow it off. There is no claim here. Because it is made by a non-company. So you can only claim family planning expenses if it is made by a company. So pay attention to that. Next, if it is going to happen to a company or any other category of persons, 1/5 of the preliminary expenses can be claimed as a deduction, or 1/5 of the VRS expenses can be claimed as deduction. If it is family planning expenses which is incurred by company, then company can also claim 1/5 of the same as a deduction. Yes, these are all deferred expenses, people, where expenses can only be claimed for 1/5 of its nature, which means if the P&L has no adjustment, then you claim 1/5 of the past data. But if the P&L already has the item fully debited to P&L account, you'll debit the whole amount, meaning you'll disallow the whole amount, and then you'll claim 1/5 of the same. So if the question comes and says that 1 lakh rupees is debited to P&L, 1 lakh rupees is debited to P&L, please disallow the 1 lakh rupees and then end up claiming the 20,000 rupees, because only 1/5 can be claimed as deduction. Yes or no? Yes, that is what the adjustment is. Are we clear with the adjustments? Great. We're moving on forward to section number 36. Section number 36, multiple items are there. So let's look at the left items first together. The left item comes and says if you have incurred any kind of interest on loan, which is taken on a capital asset up to the date on which the asset is put to use. People, this is borrowing cost standard. Borrowing cost standard comes and says any kind of interest expenses which you have incurred until the asset is put to use will get capitalized. Will get capitalized. So if the question says it is debited to P&L, please disallow it from the P&L and capitalize it for the purpose of computation. At the same time, people, because you're capitalizing, please note that you have to claim depreciation on this asset because asset is eligible for deduction. Yes. So one thing which most of the students will end up missing out is they will end up not claiming depreciation. Please ensure that you claim depreciation on this. What will you ignore of for the purpose of computation? You will ignore for the purpose of computation any interest on loan taken after the asset is put to use if it is there in the P&L. Yes, because if the asset is already put to use and there is no borrowing cost standard coming into picture, interest will be assumed as incurred for the purpose of business and therefore claimable as a deduction. Yes. Great. The next item, people, is something very critical, something called as employer's contribution to RPF. Now, when it comes to employees and employer's contribution to RPF, rules come and say that when it comes to employer's contribution to RPF, the payment has to be made on or before the due date of return filing. If you have not made the payment on or before the due date of return filing, the expenses, if it is there in the P&L, will get disallowed. That is what this line item says. So, employer's contribution to RPF, if not deposited within the due date of return filing, gets disallowed. On the contrary, people, when it comes to employees contribution, income tax says employees contribution is normally not even a P&L item. But if you have not deposited the employees contribution before the due date of the respective act, PF Act or ESI Act as the case may be, then in that case, whatever delay you make will be treated as an income for you, and that too permanently. And therefore here it says employer's contribution to RPF. Then it comes and says any kind of employee's contribution to RPF if it is not deposited within the due date of the respective act. If it is not deposited within the due date of respective act, if it is already not credited to P&L account, then I will credit it right now. At the same time, people, please notice that if I've already disallowed from the employer's contribution in the past, like I said, you have to make the payment before the due date of ROI. If you don't make the payment before the due date of ROI, you can disallow it, but you can claim it in the past next years as well. Right. So items which are to be claimed as deduction is any kind of employer's contribution to RPF which is disallowed in the earlier years and is paid in the previous year. If it is employer's contribution, notice only employer's contribution, if it is disallowed in the past years, can be claimed as a payment in the next years. For employee's contribution, I don't have any such claim. This is a permanent income. Yes or no? Great. Then comes section 3617 and 3617A, which talks about bad debts. Income tax says if you have any bad debts which you have shown in the P&L, and then later on have recovered this bad debts, then whatever bad debts which was allowed earlier and is recovered in the previous year will be taxable in the current year. Second, income tax says if you have any bad debts which is recovered by the previous year but is already offered to tax by the assessing officer in the earlier years, then I don't need to offer it as income. And the last one says if you have bad debts incurred in the previous year after the debt is written off, then you can claim it as a deduction. Yes. So what is happening in bad debts, people? If it is bad debt of the current year, please claim it as deduction. If you have bad debts of the past years and you have received the money in the current year as a recovery, then you will add it as an income. On the contrary, if you are going to have any bad debts which is already allowed in the past years but assessing officer denied the claim to you, then on recovery basis I will not be taxing it. Next one comes and says any kind of bad debts written off by the successor of the business is also allowed as a deduction. Yes, just because the successor has taken over the business does not mean that the successor cannot claim the bad debts of the past history. If the past person has already disallowed, if the predecessor has already offered the income to tax on debtor basis, in the current year if I am writing off the bad debt, that is claimable as a reduction, clarified by Veerabhadra Rao and Koteshwar Rao and Co., which is a Supreme Court judgment. Yes, I wanted to dwell upon this bad debts a little bit more, people, so I am giving you a simple example. Imagine a case if the question comes and says that there is a sales which was made of rupees 50 lakhs. There was a sales which was made of rupees 50 lakhs in which what had happened is the assessee has decided that the assessee wanted to write off a bad debt. Yes, so the assessee wrote off a bad debt of rupees 50 lakhs. However, during the course of assessment, it so happened that the assessing officer disallowed 30 lakhs worth of bad debt. In simple words, I got a claim of only 20 lakhs. So notice this carefully. I had proposed to claim a bad debt of 50 lakh rupees in which assessing officer said I will not allow bad debts worth 30 lakh rupees. I will rather only allow 20 lakhs worth of claim. I will rather allow only 20 lakhs worth of claim. Now in the current year, what has happened? No, in the current year, I have got a bad debt recovery. I have got a bad debt recovery of, let's say, 42 lakhs which is showing in my P&L. What is the treatment of this is the question. Now people, I am only in the current year. So notice the current year, what is happening. In the current year, I have received sum of rupees 42 lakhs. But as an assessee, what will I go and tell? As an assessee, I will go and tell the assessing officer that, dear sir, please note that even though I have received 42 lakhs in the current year, in that 42 lakhs, I had already disallowed 30 lakhs in the past years. Because you were not ready to give me the claim. In this 42 lakh rupees, I have technically already offered to tax 30 lakh rupees in the past. Yes, now because I've already offered the 30 lakh rupees in the past, why should I be offering it right now would be the proposal. And therefore, you'll go and tell the officer that, sir, I only want to offer 12 lakhs worth in the current year. What is 12 lakhs, people? Out of 42 lakhs, 30 lakhs already offered in the past, and therefore only 12 lakhs to be taxable right now. Yes, now understand this carefully. Tax is coming and saying you should offer only 12 lakhs. However, your P&L is having 42 lakhs. What is the proposal? I will say, to move from P&L to my tax, I will reduce 30 lakh rupees as a deduction. Yes, I will remove 30 lakh rupees as an allowable item. I hope everyone is understanding this part. This is what I have been discussing right now, people. When a bad debts is recovered in the previous year but was already offered to tax by the assessing officer in the earlier years, I will not offer it to tax in the current year, because the 30 lakh rupees is already offered in the past years. Are we clear? Yes, please mark this one as very, very important as an adjustment, people. This is something which is tested both at inter and final level multiple times. Clear? Great. Next one, people, when it comes to provisions, income tax also comes and says if you have incurred any kind of provision for loss on subsidiary, that's merely a notional loss. There is no such actual loss happening here. Therefore, it will get disallowed. There is no such provisions which is allowed as deduction. Great. Now moving on to section 37, people. Section 37 talks about items which are general expenses which can be claimable or not claimable. Income tax says if you have incurred any kind of penalty, compounding fees, settlement fees and all, if you have paid for under any law, then it is not allowed as deduction, and therefore if it is already debited to P&L, please disallow. Next, if it is any kind of interest or fees which is paid under section Income Tax Act, then it is also disallowed. While this is not section 37, people, this is section 48 too, but it is good enough to refer. On the right side, what and all items will you ignore of? Any kind of penalty which is paid for non-fulfillment of a terms under a contract. Yes, understand, people, section 37 only disallows those expenses which are paid for a law payment. This is not a payment of a law, this is for a payment of a contract, and therefore it is still an allowable deduction. It does not have any disallowance under section 37, so you can ignore this adjustment. Next, any kind of interest and fee which is paid under any law other than income tax law will be allowed as deduction, because this is not section 48. 48 only talks about Income Tax Act. 37 has no restrictions on interest and fee, and therefore that will get allowed as a deduction. Next, any kind of fees which is paid for filing tedious returns will be allowed as deduction, because it is also assumed as compensatory in nature and not treated as a mandatory payment. Yes, and therefore this will also be allowed as reduction. All these three items, people, if it is debited to P&L, I don't have to make any further adjustments. I will ignore it of my computational purposes. Next ones, any kind of CSR expenses which is incurred as per Companies Act will get disallowed, because it is debited to P&L account. The rules of section 37 2B will come into picture. 37 comes and says CSR expenses will get disallowed if it is, because it is not incurred for the purpose of my business. Next, any kind of donations given to political parties and electoral trusts will also get disallowed, people, because it is not allowed as deduction. Please note that these items can be claimed as deductions under section 80G and 80GGC. Yes, so you can claim this as deductions under 80G and 80GGC subject to those conditions getting satisfied. But yes, from PGBP perspective, I will disallow this as a deduction. What items will I ignore for the purpose of my computations? Any kind of scholarship fees which is paid for promotion of events. Please notice, people, although scholarship fees can be tantamounting to donations, if it is a scholarship fees which is promoting my business, then in that case it is no more a donation, and therefore it becomes a business expense. If you can prove it as a business expense, then it is allowed as a deduction. I don't need to treat it as a disallowable component. If it is there in the P&L, then I can claim it as a reduction. I will ignore the adjustment as it is, because it is going to be considered as a business promotion expenses. Clear? Great. What other items can I disallow, people? Any kind of personal expenses which is incurred for self and family members. This is fairly obvious. If you're going to have personal expenses and it is not allowed under section 37, please disallow those expenses. Any kind of interest which is paid to MSME Act is getting disallowed, not because of Income Tax Act, but because there is a section called as 23 of MSME Act. Yes, so section 23 of MSME Act is making a disallowance here, so please disallow that as an expense as well. What other items? You have any kind of gift, freebies, bribes, or any kind of secret commission which is given under violation of any law. Payments made to doctors, payment made to gundas, police officers, all those things will all get disallowed because these are not allowed under any laws, and therefore those will get disallowed. Next items are what, people? You have items like legal expenses which is incurred for issue of right shares. For right shares. Now, this is something which I wanted to pay attention to, people. There are some case laws coming up. The first case law which comes and says that if you're going to incur any right shares, whatever expenses you incur for any right shares will all be disallowed because it is capital expenditure in nature. However, please notice that even though this is capital asset, this is not having any enduring benefits, and therefore no depreciation is claimable on this. This is a legal expenses which is fully disallowed with no depreciation. With no depreciation. CIT versus Motor Industries Limited came up with this clarification. On the right side, people, if you have any kind of interest and debentures which is paid for debts which are paid upfront, then it is allowed as a deduction. Yes, notice this is only for shares, not for debentures. So any expenses which you incur on debentures will be fully allowed as deduction. No restriction on that. The case law of Taparia Tools basically came and clarified that if you have made interest on debenture payment, not just for the current year but also for the future years, then also you can claim it as a deduction even in the current year upfront. So if the question comes and says that there is some debentures which you have issued for a period of 5 years and you have incurred some expenses on these debentures for the next 5 years, but the payment of the whole thing has happened today itself, you are permitted to claim the whole deduction in the current year itself, and you do not need to wait for the next 5 years. So a proposal by the assessing officer to defer will not be required. You can claim the whole deduction in the current year itself. Items which can be ignored of, people, are the critical ones. Any kind of expenses which you have incurred for the purpose of bonus issues or any kind of debenture payments. Notice, for right shares, I will disallow the expenses because it is increasing my capital base. But when it comes to bonus shares and debentures, they are not going to increase my capital base and therefore will be treated as a revenue expense. This is what was clarified in General Insurance Corporation. Yes or no? Yes. So please pay attention to this fact. What is happening, people? Right issues, whatever expenses I incur, I will disallow because it is capital in nature. Bonus issue or debentures, I will treat it as a revenue expense and therefore will allow it in P&L account. If it is already there in P&L account, I will ignore it off. That is what is happening. Clear? Yes, the next one is again a case law, people, which you have to pay attention to. This has been tested in exam multiple times, that when you are going to incur any expenditure for abandoned projects. What projects? Abandoned projects means you started a new project and then you decided that you want to stop the project because it is not feasible anymore. I will ask you a simple question. Tell me, was the business an existing one or a new business? If it was an existing one, people, then you will claim it as a revenue expense because in the same business you were trying something new and it did not flourish out. This is what was clarified in CIT versus PVR or Priya Village Roadshows. However, if you are going to start business for the first time, if you have started a new business and then you have abandoned the project, income tax says this will disallowed as it is a sunk cost. It will be disallowed as a sunk cost. Also, because the new business has never flourished and the asset was never created, you will not claim any depreciation also. This was clarified by a case law called as McGraw-Ravindra Laboratories. Now, McGraw-Ravindra Laboratories is not part of your syllabus, people. However, ICI at multiple occasions has tested this question and people end up quoting Priya Village Roadshows and claiming it as deduction. Please don't do that. Notice carefully that if the abandoned project is from an existing business, I have a P&L in my hand and therefore I can claim it as a deduction. It will be called as a revenue expense. But if it is a new business, then I don't have a P&L in my hand for that business. I have a P&L for a different business. So that P&L business expense cannot be claimed in this P&L and therefore that gets disallowed as a capital expenditure. I will also not be claiming depreciation because there is no asset in existence. Clear? Great. Items which can be claimed as a deduction, people, is any kind of expenditure which is incurred for granting of ISO certificate. Yes, understand ISO certificate is more of a common thing which happens every year and therefore there is no capital asset which is coming into existence because of this. So therefore whatever expenditure you incurred for ISO certificate will be treated as a revenue expenditure. If it is not claimed in your P&L account, you can claim it in your P&L as a deduction. This was clarified in Infosys Technologies Limited, Karnataka High Court. Items which I can ignore for the purpose of computation, people, is any kind of cost of glow sign board. Yes, if you have made a glow signboard for your business and you have put it outside your premises and you have claimed that whole thing as a revenue expenditure, you have done the right thing. You've done the right thing because these assets do not have any enduring benefits and therefore can be claimed as a full deduction in your P&L. If it is already there in P&L, I will make no adjustments. I will ignore the adjustment off. Then any kind of expenses which are incurred for bringing drinking water to village in a place where the factory is situated. Normally in this instance, most of the people will come and say this looks like a CSR activity. However, the answer is not true. Notice that the place is having a factory also, which means when I bring drinking water to the village, it will not just benefit some outsiders, it will also benefit my own employees. Because it is also going to be benefiting my own employees, I can treat it as an employee benefit expenses and therefore claim it as a full deduction. Yes, this was clarified in Madras Refineries Limited, where Madras Refineries Limited were able to prove to the tax authorities that when I brought the drinking water to the village, it was also benefiting my own employees and therefore it became a business expense. It is no more a donation or a CSR expense, claimable as a deduction. Next item is any kind of loss which has happened by theft or embezzlement. People, if I have lost money because of theft or embezzlement, there is nothing which is creating a capital nature item and therefore this will be called as a revenue expense as it is incidental to my business. So this was clarified in Dandaker Machine Works, where they came and clarified this will also be claimed as a business expense. If it is there in the P&L, I can claim it as a deduction. Are we clear? Yes. Great. This is what your section 37 related adjustments looks like, people. So we have almost covered 4 pages of adjustments, section 37 variko. I'm at time of 15 minutes right now. I hope everyone has been able to understand what this cheat sheet looks like. It's a very, very powerful sheet, people, where you're able to cover everything in a bird's eye view, where I'm able to understand what is to be added, what is to be ignored, and what is to be reduced. Please go forward, people, and when you next time try doing a question of PGBP, try to use this cheat sheet and see where this adjustment is and make an adjustment accordingly. See if you're able to get the right answer. Yes, I'm pretty sure you should be able to get a right answer if you have understood this cheat sheet properly. We will understand it to that extent. Are we ready to go to the next adjustments? Yes, let's move on forward to what we call as disallowances. Looking at section 40A, we're looking at first one, which is the TDS defaults. Section 40A-I and section 40A-IA talk about the fact that if you're going to incur any expenditure which is made to a resident or made to a non-resident, yes, made to a resident or made to a non-resident, where the TDS is not deducted within the previous year, or if the payment which is deducted is not paid before the due date of return filing, then the expenditure gets disallowed. How much do we disallow? We disallow 30% of the expense if the payment is made to a resident and 100% of the payment if the payment is made to a non-resident. Yes, so those are the disallowance which we are going to take into consideration. But notice, people, this is a temporary disallowance, which means if a disallowance is made already for these items in the past and in the current year if you have made the payment of TDS, then I am going to claim this as a deduction. Yes, so if I have incurred any expenditure of which TDS is deposited in the current year, if it was disallowed in the past year, I can claim it as a deduction. Items which are going to be ignored, people, is items which are not liable for TDS. You may get sometimes questions in exam where ICAI may give you a question and the question may come and say TDS is not deducted. Before you make a decision on whether it should be disallowed or not, first of all, check whether disallowance will accrue or not, meaning whether the payment is really liable for TDS or not liable for TDS. For example, you may get a question which the question may come and say that the expenditure has been made to a transport operator who is owning less than 10 vehicles and has given you a declaration for the same along with PAN number. Now, for those who know section 194C, 194C would come and clarify that if a transport operator gives you a declaration saying he has less than 10 vehicles and is also giving you his PAN number, then TDS is not applicable on his transactions. So those kind of things is where you have to pay attention to, people. If an expenditure is anyway not liable for TDS and you have debited it to P&L, there is nothing to be disallowed and therefore the payment will remain as a deduction. So that payments will get ignored off. After 40I and 40IA, people comes on some things like 40A2, where if a question comes and says they have made provision for deferred tax, then in that case you should know, people, because we're starting with net profit before taxes. Ideally, this should have not been part of the P&L itself. Since it is part of P&L, I am going to disallow it off. Yes, next one, and the critical one saying tax on non-monetary perquisites which are paid by the employer. Because the non-monetary perquisites are exempt in the hands of employees, it is disallowed in the hands of employer. So these two payments will also get disallowed. So please pay attention to that. Yes, great. Then we are moving on to something called section number 40A2. 40A2 comes and says that if you're going to make any payment to your related parties and the payment to related parties is found to be excessive or unreasonable, such payment will get disallowed. Yes, so any kind of payment made to relatives and associate of the person which is revenue in nature will be disallowed to the extent it is considered as unreasonable or excessive. Notice carefully, people, that this is only disallowed if it is revenue in nature. Meaning, if it is not going to be revenue in nature and it's going to be capital in nature, I would have anyway disallowed this as a capital expenditure itself. So there is nothing further for me to disallow under section 48(2). This will only get disallowed if it is not a capital item, if it is a revenue item. Yes, items which are to be ignored, people, is all those items which are from revenues and from relatives and associates will get not treated as a adjustment if it is revenue in nature. Understand the difference here, people. 48(2) talks about expenses. So if an expense has been done by you which is treated as unreasonable expenses, I will disallow it off. But if it is a revenue which I have done unreasonable or excessive, it doesn't matter. It doesn't matter. So if you get a question where the question comes and says the sale of furniture has happened to your related party at an unreasonable price, or if it is done at a price lower than what you should have got, in that case I will not make any treatment. The treatment is only for expenses. Treatment is not for incomes. Yes. So understand this carefully. The revenue here does not mean revenue nature. The revenue here means income. Yes, so if it is an income from relative or associate, then only it is ignored from an adjustment perspective. If it is an expense, then I will disallow it off if it is treated unreasonable or expensive. Yes, then we have section 48(3). 48(3) talks about payments exceeding 10,000 rupees other than by permissible modes. So if you have done payment to a person exceeding 10,000 rupees on a single day to a single person, I will disallow it if it is already debited to P&L. Items which will not get disallowed is any kinds of payments which is made excessive of 10,000 to a farmer. These payments are allowed in cash also, therefore no treatment on this. If it is already there in the P&L, I will leave it off. I will ignore it off. If it is made payment to an employee which is deputed to a location exceeding 15 days, then in that case also I will not make a disallowance if the person does not have a bank account in that location. And finally I will ignore it off if the payment is made up to 35,000 in cash to a transport operator. Up to 35,000 in cash to a transport operator is not also treated as a disallowance. That will also get ignored off. Anything else will get disallowed. Yes. Great. Then we have section 48(7), people. Section 48(7) comes and clarifies if you have had any provision for gratuity which is created in the year, then I will disallow this expenses, and I will only allow this expenses if it is paid on or before the due date of return filing. Yes, what is allowed as deduction is all amounts which is paid out of the provision for gratuity will be allowed as deduction. Great. Then we have section 48(9), the amendment of the current year, people. Therefore, I want you to pay attention to this. The amendment of the current year comes and clarifies that if you are going to have any kind of employer's contribution to NPS exceeding 14% of the salary alone will get disallowed. If it is within 14% of the salary, I can claim it as deduction. But if it is exceeding 14% of salary, I will disallow this expense in the hands of the employer. For this purpose, the salary here means your basic pay plus dearness forming part. You will take that into consideration for the purpose of computing your 48(9). Yes, it's an amendment of current year, therefore I expect questions on this. Please pay attention to this one. After 48(9) comes the critical one, people, something called as 43(b), one of the most tested items in exams. 43(b) basically comes and gives you a list of items which has to be paid on or before the due date of return filing. If you have not made these payments before the due date of return filing, these payments will get disallowed and will be allowed in the year in which the payment is made. What are the items, people? The items are any kind of bonuses, any kind of commissions, any kind of leave encashment, any kind of tax, duty, cess, fees which is payable under any laws, any kind of interest on loan taken from banks, PFIs, NBFCs, and any kind of use of railway assets. These are all payments which will get disallowed if the payment is not made before the due date of return filing. These payments, if it is made in the subsequent years, then it will be allowed as a deduction and therefore can be claimed as a reduction. What are the items to be ignored of? We will come to that later. Coming to the next part of 43(b), people. 43(b) comes and says you also have one more item called as payments made to micro and small enterprises. If it's a payment being made to micro and small enterprises and it is done beyond the due date of 45 days in case of written agreement or 15 days in case of oral agreement, then that payment will also get disallowed and will be allowed in the year in which the payment is made. Notice one thing very carefully, people, that this is talking about the payment directly. Whereas in section 37 we spoke about interest. In interest there is no such rule. Interest to MSME is fully disallowed. The payment on the MSME alone is disallowed if it is made beyond 45 days of oral written and 15 days of oral. That is what the rules are. Yes or no? Yes. So please pay attention to that. Then what is not to be disallowed is any kind of payment made to medium enterprises. Understand, I am only disallowing micro and small enterprise. Medium enterprise payments are not getting disallowed, so that remains as it is. That can be ignored off. Couple of case laws related items for you. First is that just by you giving a bank guarantee as an alternative for payment does not tantamount to actual payment. So there is a case law called McDowell's, where McDowell's has come and clarified that if you are going to make a payment, then only you can claim a deduction under 43(b). Merely by giving a bank guarantee in replacement of a payment does not satisfy the payment. It will still be disallowed. I will give it as a deduction only when the payment is made. Second is a clarification as a circular, where the circular comes and clarifies that if you have taken an interest which you have disallowed in the past years and in the recent year converted it as a loan, just by converting it as a loan does not tantamount to payment. You will have to make the repayment of this interest turned to loan, which means the principal repayment of the component of the interest which has been converted has to be repaid off in order to claim that as a deduction. So that is what this item says. That is what this item says. I hope this one is also clear for you people. Yes, great. After 43B comes 41 people. 41 where income tax comes and says, if you have done any waiver of principal component of a capital asset, then in that case I will treat it as a income. I will treat it as an income. This was subsequently introduced in the income tax laws. So any waiver of principal component of the loans will be treated as an income if at all that is treated, if at all that is not already credited to P&L account. Second, any kind of liability which is foregone for a creditor. So you will get many adjustments like this people in exam, where the question will come and say there is a creditor which was supposed to pay me 10,000 rupees, but I have decided to forego his liability. He has decided to forego his liability and he has only asked for 6,000 rupees. In that case, the 4,000 rupees which he has not asked you anymore is to be offered as income. And if it is already offered to income, you can treat it as an ignorance. But if it is not offered to income, please offer it as income. Next, you have any kind of GST refunds by the authorities which is not refunded to customer. This is some adjustment which has come 3 or 4 times people, where what will the ICI question come and say is, ICI will come and say there is a GST which there was a GST which was paid by you to the tax authorities. Later on, you went on an appeal and you got this whole money back. Now, 10 lakh rupees was received back by you from the GST authorities, in which only 4 lakh rupees was refunded to the customers, which means the balance 6 lakh rupees which you have not refunded to the customers, you're using it in your own business. To that extent, this will become a government grant and therefore will become fully taxable. That is what has been clarified in Tirumalai Swami Naidu and Sons case law, where Supreme Court has come and abided to this decision. So if it is not there in the P&L already, please treat it as an income and tax it in your P&L. Great. Yes, this is your section 41. Now, some other adjustments not relating to PGBP but coming from the PGBP chapter. First thing called as ICDS adjustments. Income tax comes and says when it comes to ICDS 1, if there is any kind of MTM loss which is taken on unsettled derivatives, then in that case that MTM loss is notional in nature and therefore has to be disallowed. So therefore, please disallow those kind of expenditures from your P&L. You will not be able to claim it as a deduction. Yes, next one comes and talks about ICDS 2, which talks about inventories. ICDS 2 of inventories come and say that when you have a firm, when the question comes and says that the firm is under a dissolution model, ICDS 2 comes and clarifies that if the firm is dissolving itself, then whatever is the cost of the closing stock, whatever is the cost of the closing stock will no more be cost or NRV, whichever is lower, it will directly be the NRV alone. Yes, so it will never be cost or NRV whichever is lower, it is always the NRV. And in this case, if the NRV ends up being higher, then you have to report it as per NRV, which means you'll have to add that additional income. Yes or no? Yes. So one classic question which is asked in exams in the past also people, that if the cost of the stock was showing 1 lakh rupees but the NRV showing 1 lakh 20, normally you will always account it at 1 lakh, so therefore there is no problem. But if this time the firm is dissolving itself, you cannot record it at 1 lakh, you have to record it at 1 lakh 20. Because you're going to record it at 1 lakh 20, your closing stock will increase. Because your closing stock is increasing, your profit will increase, and therefore you need to adjust the differential 20,000 in your P&L. That is point number 2. What comes to closing stock as an ignorance item, people, is any kind of interest expense on closing stock which does not qualify as qualifying assets. So if the question comes and says that they've incurred some interest cost on a closing stock and they would like to charge it to, they would like to not take it to my cost of the asset, please don't do that. You can only treat it as an expense because it is closing stock, and closing stock generally is not a qualifying asset. You can only add it to the cost of the asset when the asset itself is a qualifying asset. If the question says it is not a qualifying asset, keep it in the P&L. If it is already there in the P&L, there is no adjustment to be made. You can ignore the adjustment off. Question number 3 is your ICDS number 3, which is talking about construction contracts. In construction contracts, certain things which ICI has asked in the past. First thing is called as retention money of construction contracts, which is withheld by the contractee. If the question comes and says that there is some money which were due, 1 lakh rupees is due to you, in which 10,000 rupees has been withheld by the contractee, saying that I'll give it on the completion of the contract, that does not mean that it's not an income. It is still an income. Just because money is withheld by the contractee, it does not absolve you from receiving the money in the later stage, which means today itself the money has become due to you and therefore it is fully taxable. If it is there in the P&L, you can ignore it off, but if it is not there in the P&L, please add it to your income statement. Second is called claim of escalation price on construction contracts to be taxed in the previous year in which certainty of the realization is received. So if the question comes and says there is a price escalation which has been done because of market conditions, in the year in which you're certain that you're going to receive this money, that year you will have to tax it. you will have to tax it. Just because you're going to receive the money tomorrow does not mean that you will tax it tomorrow. You can tax it today itself if you know that you're going to receive the money today. That is what ICDS 3 comes and talks about. Coming on the reduction part, people, what does the reduction part come and say? If you're going to have a profit from a construction contract where the construction is not for a period exceeding 90 days, ICDS 3 comes and clarifies that if the construction period is not more than 90 days, you do not follow percentage of completion method, you follow project completion method. If you're following project completion method, you will tax the whole money only on the date on which the project is completed. So if a question comes to you where it comes and says that the construction contract is for a period less than 90 days and they have only recognized 10% of the revenue in the current year, proposing the balance 90 to be done next year, you will say the 10 also will not be recognized in the current year because this is on project completion method. I will defer the whole income and tax it only in the next year. Since it is already there in the P&L, I will reduce it from my P&L. That is what this adjustment talks about. Are we clear? Great. Next one, people, is any kind of subsidy which is received from government for purchase of an asset. People, this is your government grant standard. ICDS comes and says if any subsidy is received from the government, you will ask yourself a 2 questions scenario. Question number 1, is it subsidy received for capital asset or is it subsidy received from generic natures? If it is subsidy received for generic natures, then you will take it as a claim and add it to your income statement. That means if any government grants is received other than with respect to capital assets, it is already credited to P&L account. You will ignore the adjustment of because it should be part of my P&L account. But if it is a subsidy received from the government for purchase of a capital asset, then in that case it should not be offered to income. It should be reduced from the cost of the asset. So which means if it is shown in the P&L item, you can reduce it from your P&L item and add it to your cost of the asset. The one adjustment which has come in IC exams on multiple occasions is this one, which says any kind of industrial power tariff concession which is received from state government will also be considered as a government grant. So if you see something called industrial power tariff commission, you can come and clarify saying that this is a government grant and therefore should be there in the P&L. If it is already there in the P&L, I will treat it as an ignorance item, but if it is not there in the P&L, I will add it to my P&L. Great. Then we have something called ICDS 10, which talks about provision, contingent asset and contingent liabilities. One question which was asked in the past is that they came and said there is a provision for wages payable to workers. Is it uncertain? No. This is a certain provision which is there and therefore this will be treated as an expenditure. If it is already there in the P&L, I can treat it as it is. If it is not there in the P&L, I can claim it as a deduction. ICDS 10 permits you to do so. Yes. After ICDS adjustments, people, some more adjustments which are left is section 40BA and section 40B. I know this is not something to be placed here because it is after all those things, but in the order of sequence, this is the most logical sequence to follow. First one is section 40BA, which talks about all payments made to AOPs and BOIs. Income tax comes and clarifies if any salary is paid to AOPs and BOIs that is not claimable as a deduction, you will tax it in the P&L. Yes, so AOP or BOI cannot claim any salary or interest paid to members as a deduction. That will get fully disallowed, so you will disallow that. When it comes to your the person comes and says any share of profit or remuneration which is received by a person from an AOP or BOI, then the person will be exempt from tax on this if the AOP or BOI is paying tax at MMR. This is not from the perspective of AOP, this is from the perspective of the member. So if the member is going to receive any kind of share of profits from the AOP or BOI, that will be fully exempt from his hands if the AOP is going to pay tax at MMR. If the AOP is going to pay tax as per normal slab rates, then in that case it will be taxable in the hands of the person as well, but you will be eligible for something called as relief under section 86. So you'll keep that in mind. Yes. Now coming to the partnership firm, if you are a partnership firm, people, income tax says whatever salary you are paying to all your partners will be fully disallowed because you have to compute it as per the book profit computation. Next, any kind of interest paid to partners will be fully disallowed if it is exceeding 12% per annum, meaning anything more than 12% per annum you will disallow, anything up to 12% you can claim it as deduction, and then any kind of interest or remuneration which is not authorized by the deeds will get disallowed. Yes, so you will only get a claim if the deed is authorizing these kind of payments. What can be ignored of as a member, people, any share of profit from the firm is fully exempted from taxes, and therefore any share of profit which is received by the partnership by the partner from the partnership firm should be reduced from the P&L account if it is already exempt. What should be ignored of, people, is any kind of interest paid to partners on loan extended in representative capacity. So if the question comes and says that I am a partner in the firm, but my HUF is giving a loan to the firm, in that case the HUF will not be guided by the 12% rules. HUF, whatever interest is paid, will be fully allowed as deduction subject to section 40A2. Yes, so if 40A2 permits 14% also, then 14% will be treated as a deduction. But if the 40A2 comes and says you can only pay 12%, then in that case you will restrict it to 12%. Clear? Yes, great. If you do it till here, people, what we'll get is the whole adjustments which is required for PGBP. Now, we started with net profit before taxes and made all these adjustments. By this time, if you're a firm, you'll arrive at something called as book profits. Yes, this will happen only if you're a firm, people, so pay attention to it. If you're a firm, then you'll arrive at something called as book profit. If you're not a firm, you can directly ignore these steps and you'll arrive at PGBP. But if you're a firm, you'll arrive at something called as book profit, in which now I will come and compute how much salary can I give. Yes, how much salary can I give will be computed as per section 40B. The amendments of current year come and clarify that you will start computing your book profit, which is what we have on the top. In the book profit, the first 6 lakh, you will be eligible for 90% of the book profit or 3 lakh rupees, whichever is higher. Whichever is higher, pay attention, it is whichever is higher, it is not whichever is lower, it is whichever is higher. Or the balance, you will give 60% of the book profits. 60% of the book profit. So do a slab rate computation and you'll find out the allowable salary under income tax. Compare it with the salary actually provided to the partners. Yes, compare it with the actual salary provided to the partners. Whichever is lower will be the salary which is payable. That salary payable can be claimed as a deduction, and therefore you'll arrive at PGBP. And therefore you will arrive at PGBP. Are we clear till here? Yes. Now this step is not required for a non-partners. It's not required for a non-partnership firm. It is required only for partnership firms. So please pay attention to that. But yes, if you have arrived at PGBP statement, people, what else can you do? You have now 2 more deductions which is there, something called as section 33AB and section 33ABA. This section comes and says that if you have made any deposits to tea, coffee, rubber development account or any kind of deposit to site restoration fund, then whatever amount you're depositing on that, whatever amount you're depositing there, or 40% of the PGBP in case of tea, coffee and rubber, and 20% of PGBP in case of site restoration funds can be claimed as a further deduction. Yes, so if you're into any kind of tea, coffee, rubber business, then whatever PGBP you get on the top, that number, you will take 40% of the number, compare it with the amount you have actually deposited in tea, coffee, rubber development account, that can be claimed as a further deduction. If you are in site restoration fund, then you can claim 20% of the PGBP as a further deduction. If you claim those deductions, people, you will get your final PGBP answer. But if you have already done such deductions in the past, and you have failed to satisfy certain conditions of 33ABA and 33AB, then in that case, I can ask you to add it back to your income statement. What are those defaults? Defaults is that you have made an installation of the purchased asset in office premises. Yes, 33AB and 33ABA say that whatever money you deposited in the development account should only be used for purchasing assets, that too for use of the operations. If you're going to use the asset in your office premises, then that is not allowed as deduction, other than one item which is called as computers. Computers alone can be bought even if it is installed in office. Anything other than that, if you're installing it in office, then I will not permit it as a deduction. If you have withdrawn the money and used it for these purposes, then I will add it to my income statement. Second, non-utilization of the amount which is withdrawn from this tea, coffee and rubber development account in the same previous year. Yes, there is a specific rule, people, that if you're going to withdraw the money from the development account for purchasing assets, you need to use the money in the same previous year itself. If you're not using the money in the same previous year itself, I will add it back to your income statement because I already claimed it as deduction in the past. So I will add it back to my income statement. And third and the most critical thing, whatever assets you have bought, you have to use the assets for a period of 8 years. If you're not going to use the asset for a period of 8 years, then whatever sale value you have on these assets will not be allowed as, will be treated as an income statement, will be treated in your income statement. So I will add it to my incomes. I'll add it to my income. So 3 things which will happen, people, if you default in your tea, coffee, rubber development and site restoration funds, is that you should never buy these assets for installation in office premises except for computers. Whatever money you withdraw from the fund should be used only in the same previous year. And third, whatever assets you've bought should be used for at least a period of 8 years before you sell it outside. Yes, failure to do any of these things will treat you an income. So these 3 incomes will get added if at all the question requires for you to do so, and then you will arrive at the total additions. That total additions, if you take into consideration, you will now arrive at what is your PGBP as per normal computation. Now, if you are ending up becoming an individual head chef for a partnership firm in the question, if the question says you're either an individual head chef or partnership firm, there is an additional thing for you to check, something called as presumptive income. Yes, something called as presumptive income. So you will check that also into consideration. If the presumptive income is lower than that, then you can ignore all the steps above and you can directly go to presumptive income. How does presumptive income operate? We have 3 sections under presumptive income: section 44AD, section 44ADA and section 44AE. Section 44AD comes and says that if you're running a business where the turnover is less than 2 crores or 3 crores in case you're doing all transactions of turnover within 95% in permissible modes, then in that case you're 44AD. 44ADA comes and says if you're in profession having a turnover up to 50 lakhs but 75 lakhs in case 95% of the turnover is received by permissible modes, then you're under 44ADA. And third 44AE comes and says that you're a transport operator which is owning less than 10 vehicles at any time during the previous year, then you will be under 44AE. In all these cases, people, I will do presumptive income based on what? 44AD will do presumptive income based on 6% of the total turnover if the turnover is received in permissible modes before the due date of return filing. And 8% if it is done by any other reasons. If you are a professional, then professional will be taxable for 50% of his gross receipts, and if you are a transport operator, then you will check whether you are carrying a heavy good vehicle or normal vehicles. If you are carrying a heavy good vehicles, then it will be 1000 per ton per month, but if it's any other vehicle, then it is 7500 rupees per month for all the period that the vehicle was owned. Yes or no? This will become your this will become your presumptive incomes. Now during presumptive income, one thing is to be noted, people, that when you do presumptive income, no expenses, no disallowance, nothing will be taken into consideration. The numbers given above is the final answer, except for one item where if it is 44A, you're a transport operator, you can still claim your partner's remunerations. So partner's interest and partner's salary is assumed as not being part of 44A, so that alone can be claimed. But in 44AD and 44ADA, you will get no such adjustments. If you do all this, people, you will now arrive at what is your PGBP as per normal and PGBP as per presumptive. Choose whichever is lower. Yes or no? Yes. Once you do that, people, you will now have the final PGBP. But if the question comes and tells you that you are a person who's running an agricultural operations, then this PGBP is also called as composite PGBP, people. It's not called as the final PGBP, it's called as composite PGBP because this PGBP also has elements of your agricultural business. In that case, I will then go on to my rule 7, rule 7B, rule 7A, 7B and rule 8, where I will now remove some items as an income for the purpose of agricultural operations. If I am doing rubber business, then whatever composite income I have, in that only 35% will be treated as my PGBP income, which means 65% will be treated as agricultural income, and I will reduce that. If I am running a coffee business, then in that case, I will ask myself, am I doing coffee with growing and curing, or am I doing coffee with growing, curing, roasting and grounding? If I am doing coffee with only growing and curing, 25% of my business is my taxable business, 75% is my agricultural business. But if I am doing growing, curing, roasting and grounding, then 40% is business and 60% is agricultural operations. Similarly, if I'm running a tea business, then it is 60% of agriculture and 40% of your normal business. Yes, so that much 60%, 40%, 60%, 75%, 60 or 65% will be reduced from my computation. Once I reduce from my computation, I will arrive at what is called as my taxable PGBP. Yes, this is how you will compute your PGBP. So what will I do, people? I'll start from a net profit before taxes. All those items of added, reduced or ignored will be taken into consideration. I will arrive at my PGBP. In that PGBP, if I'm a firm, then I will do something called as book profit computation and arrive at what is my computable salary. Salary will be claimed as deduction in order to arrive my PGBP. That PGBP income will then be taken into consideration. If I'm running a tea, coffee, rubber or a site development fund, then I will claim that 40% or 20% as a deduction in order to arrive at my normal PGBP. I will compare that with my presumptive PGBP and check whichever is lower. That will be now found out as composite PGBP. In that composite PGBP, if I have any agricultural business, then I can claim that as a deduction in order to arrive at my taxable PGBP. Yes, great. This is how your PGBP statement looks like, people. I am fairly sure that every adjustment which is required for PGBP is covered here. You will often only see very rarely one or two off late adjustments which will come in ICA exams which will not cater to these adjustments. Yes, so majorly everything is covered in this. You should be able to cover your PGBP 15 mark question with this on a significant level. So I really request you all to use this sheet at least once or twice for one or two questions and see if you're able to reconcile this and able to understand this. If yes, then please take a printout of this and have it with you during your day of exams. This will be a really good document for you to cover your 15 mark questions. Yes, That's it, people. I will put the link of this document in my description box. So please go to the description box and share and download it off for yourself. If you have any of your other friends also who are running the September attempt or Jan 2026 attempts and attempting CA final direct taxes, please share it across with them also, so that maximum people can benefit out of it. After all, it's a free document, so there is nothing for you to worry about. Feel free to print it out. I purposely did not put too many colors in this document because I wanted you all to print it out in a black and white format as well and still be used to it. So therefore, there is no exceptional colors in this which requires you to print it out in a black color format. Black and white should also do. So please go ahead and print this document out, stick it on your walls, and use this as much as possible. Yes. Awesome. Thank everyone for sticking with me. I know it's been 1 hour and 18 minutes and we have solidly done the whole PGBP computation once again. For those people who want to do it along with concepts as a marathon, we have already uploaded a separate marathon video for PGBP in our channel, which will be part of your playlist. If you check the playlist, you will find a CA final September or Jan 2026 playlist. In that, you will see PGBP separately itself is there as an understanding part of the marathon. So if you want to do it like that, then you can do it from there. From an adjustment perspective, this is a very, very good video for you to work upon. Yes, so you can use this video also for your reference. Thank you, people, for watching this video. I will see you all soon with new upcoming videos. Again, like I said in the previous videos as well, if you have any recommendations, any suggestions on any other topics which you think I can help you on better, please drop it in the comment box and I will try my level best to come up with those videos as well in the upcoming sessions. Take care, everyone. Have a great learning ahead. Until the next video, see you. Take care. Bye bye.